GM, just a quick one before we get going. So, as you know, the Blockmates podcast is for informational and entertainment purposes only. Certainly shouldn't be considered as financial advice. We have absolutely no idea what we're talking about half the time. So, any investment decision you do make should be based on your own research and your own understanding of the risks involved. One more thing as well, there's around 50% of people who listen regularly who aren't subscribed yet. So, if you please could just do us a favor and hit the subscribe or the follow button or the like button, helps content grow, helps us grow, helps it reach more people like yourselves, and it means the world to us as well. So that's the last I'll ask of you. So yeah, let's get to the episode.
All right, and we are back. It is Exit Liquidity, and I have with me, as almost always, Mr. Captain Rational. We have been away for a while, and it's time to get back to it because the markets don't stop. Things keep being interesting in the realm of macro. And, I needed to exercise some macro demons. And this is the time and the place for it. So let's get it on.
Well, we got demons going on.
Yeah, we got some demons. Right now, I've been watching the long end of the curve quite a bit lately. And I don't know if you remember last time we talked, I like it's a couple months ago, but I remember being like, I don't see the market folding until you see a blowout on the long end of the curve. And I think we're starting to see that blowout. Like this is a monthly candle on the 30-year. And as this day happens, we are tagging the bottom into that trend line. And like the long end of the curve is it's important. I mean, it is what the pension funds hold. It is what insurance companies are holding. It represents duration. And that is not a good sign for things that are of high duration, as the NASDAQ's big red candle today will tell you. So
it's not that pronounced from a risk perspective. The question in my mind always is, what's different? So obviously, when structure breaks, everything starts to get weird. What is it, like the fractured mirror or something out of Doctor Strange? It's that things start, or Tenet. It's like a fire, you get a hypothermia. So that'd be so weird to see like risk assets continue to be correlated with the prevailing directionality of the bond market, which is kind of like the long end, at least. The short end still controlled by Fed policy, but it'd be like that's just look at the S&P. I mean, it's not like rolling over by 5% or 2% or 3%. The S&P is down 1%.
Yeah. And that's all like the bears have been able to muster these days lately, is like worst day is like a 1% down day. We haven't seen any true blood, but it is interesting. I mean, like, and to your point about the Fed controlling the short end, like I feel like the short end has just been bled of all volatility. And I'm not sure I'm not sure exactly what to attribute that to. I mean, I think a lot of it has to do with people not expecting rate hikes anymore. And that was validated yesterday when they chose not to raise rates. So, I mean, that I think is the main driving factor there. But like, you just haven't seen intraday type moves in the short end of the curve either. And I guess the other thing I would attribute that to is you can see on the MOVE index, our favorite little index, that bond volatility has fallen off. And like the most recent issuances have been largely on the shorter end of the curve. And so I think that there's a liquidity factor here where there's now a whole bunch of liquidity on the short end of the curve, which mutes. I mean, volatility and liquidity are basically inverse. And so when you have more liquidity in that end of the curve, you get less volatility. And so that's why you've seen this chart trend down. And I think that it's kind of kept things very stable on this end, but the lack of control the Fed has over the longer end is evident.
I mean, look, they have no control. This is uncharted territory. In my entire lifetime, I'm 40 years old, so we haven't seen a directionality change in the long end in 41 years. And this is done. This is the regime is no longer there of lower lows and lower highs on long end rates.
Yeah.
This is clearly it's a higher high. And then it'll take another couple of years to see where the low is. Maybe it'll take 1 year. Maybe we'll see a low next year, and we see a massive long end rally. But
Mhm.
I'm inclined. My base case is we see like 2.5%. Whether that comes with a complete like risk off, traditional risk off, where bonds rally and they rally to 2.5%, give or take, that which would be our high or low. So the interesting thing is, what if the long end just keeps selling and there's a fiscal conundrum?
Yes.
Bond volatility is
Yes.
completely crushed because of Fed policy, Fed intervention, RRP, repo markets, ETFP, all the acronyms they love to do from a banking perspective.
I
And
mean,
yeah,
if you're the Fed, or not the Fed, the Treasury right now, you got to be looking at this action and going, wow, maybe we need to keep pushing the front end treasuries rather than issuing more duration,
they
because
can't.
because one of the things that I think I tweeted about this a while back, but I was basically saying like, I got a chart of the RRP here, but like, here's the RRP. We were over 2 billion not that long ago. And so
True,
like,
true.
or I mean 2 trillion, sorry. 2 trillion. And it
Yeah,
wasn't that
oh my
long
God.
ago. 2.5 is where about we peaked, but like we're down a trillion already, and yields are back, like, basically where were yields in December of last year when we peaked. So in December of last year, the long end was
Spiked over 4.
way over here. So
Wow.
like $1 trillion,
And it's still
and we're here. So I guess my thing is, what happens when the RRP is drained and yields are still going up? What are they gonna do? Because they can't play hawkish and save the treasuries. I mean, they would be forced into yield curve control at that point.
the Congress is going to have to. It'll be forced into emergency session because Treasury reports to them that they have a fiscal problem. And obviously, them acquiring stuff in the balance sheet, that's whether it's explicit yield curve control or just the same QE with a different terminology, but their balance sheet expands. So, from a time horizon perspective, is 11.5 to $13 trillion that's going to come off the Fed auction next year. It's 11.5, just I think it's 10.5, just rolling debt between everything
Yeah.
between 2020 and everything that just has to be refinanced. And then
Yep.
it's obviously ongoing fiscal. And I say 11.5 to 13. Raul mentions 13. Mike Powell says 8, but I have pretty obvious data that says about 10.5 needs to be refinanced. So I like to say about an 11.5 to 13. It's going to come out of Treasury.
Yeah.
They can't do it at these rates.
I mean,
And,
well, the yield curve being inverted as it is, I mean, as if I was Janet right now and I have to choose between refinancing at 5.3 on the short end or refinancing at 4.5, I mean, at the long end, 4.5 isn't bad in comparison, but they have to be wondering about the liquidity of the long end of the curve. I
how
mean,
much Treasury has been bought? So 2023 is record foreign
yeah,
Treasury purchases.
yep,
2022 was record foreign currency Treasury purchases. I found those charts very interesting.
yeah.
So the demand is there.
The
The
demand has been
problem,
there. I think some of that has to do, I haven't dug too deep into those numbers, but I think a lot of that has to do with the fact that so much was issued on the short end of the curve too, because that's the stuff that they want. You know,
so
that's the
but
stuff
they
the
want
foreigners.
it, but it's only 2 trill or a couple of trill. So the demand is through the roof, epic, historic. What the heck are they going to do about $13 trillion that needs to come out of
Well,
Treasury?
and then the other thing is this. The other thing is this, and this is something that came up during the Jackson Hole conference. Daryl Duffy, who is a Stanford professor, he's a big Treasury market guy, and he was basically proposing. And there's a great Odd Lots podcast episode about this too, but he also released a white paper as a part of Fed Week or whatever. And so if you're a real nerd, go read that thing, because it's pretty, there's some pretty good stuff in there. But basically, like, when you have these massive amounts of issuance, you increase the demand for intermediation of that market, right? And that's been the big problem over the last decade or two, I'll say. That's happened every now and then, is you get these fits in the Treasury market like this, where you get a candle that looks like this freaking guy, because the primary dealers just go, I don't want nothing to do with that. I ain't catching that knife. And they don't have the balance sheet to do it.
They're literally forced to hold inventory right now.
Yeah, there's a great chart. I'll have to see if I can find it. But there is a great chart in that Daryl Duffy paper, where he basically shows let me see, hold on, I got the paper pulled up here. Hold on. It's basically like the amount of balance sheet space relative to the amount of treasuries issued. And it basically shows that, like, things are only getting worse in the intermediation department. And so, like, the more we issue treasuries while constricting banks' balance sheets, especially primary dealers' balance sheets, like they're doing in the post SVB, like they're trying to, make it so that the banks are safer and all this stuff. But the problem is, when they do that, they can make the banks safer, but
Who's going to buy?
they make the Treasury market less safe. And that is all of banking regulation, is really kind of a lot of going, hey, look, here's this risk, let's move it over here. Not, we're going to get rid of this risk, because you can't get rid of risk, Risk is neither created nor destroyed. All it can do is be shifted around. And they like to think that they're getting rid of risk, but all they're doing is they're shifting it around. And to some extent, if you read the Daryl Duffy paper, um, I feel like his his sort of proposal is sort of in that vein too, though, because he's been a big proponent of having like basically centralized repo clearing. So no more bilateral. All repo transactions need to go through a central clearinghouse, and that's all well and good. But like my understanding is of what is being proposed here is that all you're doing is you're taking all the counterparty risk, you're bundling it up, and you're going, okay, now the central clearinghouse has all that risk.
They
And
can't
it
take this
doesn't,
kind of risk.
well, and the thing is, like, all that does, the further you move the risk away from the market actors, it just creates moral hazard. They don't have to do their due diligence anymore because now you've got the central clearinghouse that's going to take the fall, and nobody's going to let the central clearinghouse fail. So,
No, no, you could pass the risk in when the numbers crunch, but next year there's nothing like this. $13 trillion worth of issuance. Nobody has the balance sheet capacity for this. There's only one place on the planet. It's not even Japan. Japan is like turned off right now. It has its own fiscal issue, so it cannot absorb this. The ECB is a disaster. No one's going to absorb this. There is only one. There's only one logical place that a tremendous amount of money is going to go. Tremendous amount of treasury issuance is going to go next year. It's going to go to the Fed balance sheet.
yes.
And then it's going to just, this is the fractured mirror land of Doctor Strange. It's just going to get really weird when you see $10 trillion just pop onto the Fed balance sheet in a fiscal year.
Well, yeah, because every time, and this speaks to why the Fed balance sheet keeps getting bigger. Like, look at this chart. Like 2008, look where we were. This is ratio of treasuries outstanding to total primary dealer assets. So basically, the amount of treasuries out there versus the balance sheet capacity of the primary dealers, and it peaked right here. And then, you had the bailouts. And then in order to fund the bailouts, you had to issue a bunch of new treasuries. And then this just keeps climbing up. And then 2020 happens. And this is where, like, this is why you get the step change, right, in the Fed balance sheet, because everything was good from 2008 until right around 2020. And then all of a sudden, the Fed balance sheet has to go boom and catch this knife. And then they have to, like, take all that risk onto their balance sheet in order to intermediate that market. And like, it's just going to keep growing as we keep issuing more treasuries. We might not get, because there was like a, almost two, or a little, like a decade and a half almost between those. Maybe that was why the step change was as large as it was. But like, there's a lot of issuance going on all around the world. And that the speed at which it's accumulating seems to be faster and faster. So like,
exponential.
Yeah. The fact that it's only been 3 years since we last bailed them out, and expanded the Fed balance sheet to do that. And by them, I mean anyone in the Treasury, basically the world. We bailed out the world.
Dude, this is going to bump 0.2 on this bar chart next year.
Yeah.
That's how much it needs to be issued next year.
Yep. Well, and so like, so far, the raising of rates, right? It's been mostly impacting the private market, right? Because Lord knows that the Congress has not reeled in their spending just yet.
Oh my God.
And that said, like, I do think that we may see, and I think we're likely going to see, and that's what this whole like threat of another government shutdown thing is we're very likely to see a battle over this stuff as people become more concerned about the trajectory of the amount of deficit relative to GDP due to all the interest payments that we're making. Like, I mean, they should be scared. They should be scared, and they should be reeling it in. And when you see those deficits drop, this is kind of, again, this is what sort of led to some of the problems with the .com bust, right? Is that you had a government that suddenly became super fiscally conservative and actually had a surplus. I think it was it 99 or 98 that they had a surplus. And when you have a global dollar system, that's sort of what, actually I think it was 90, maybe it was 97 or 98, but it was right around the Asian financial crisis. Like we almost inadvertently caused the Asian financial crisis, I think, by having this whole deficit hawk
By tightening.
behavior. And so like that's just sort of like the rock and the hard place that we're stuck between, is that if we become fiscally conservative, we will start breaking everything.
But the thing is, this is what's going on is not, you can't even put it in the context of what happened in 2008. Nothing is comparable. The hardest thing that we need to become fiscally conservative with to balance the budget is the interest payments.
Yes.
You can't. That's the largest expense. It's larger than the military.
Yep.
Or Medicare and Social Security are larger, but you can't rein in interest expense.
Yep. And that money's got to come from somewhere. You can and I think kind of my core thesis really is that interest rates aren't going back down, at least not to where they were. We will never see ZERP probably in our lifetimes again.
I'm not. Mike Howell says it, and a lot of other folks say it. Everything is interest rate divergent at this point. It's not. That's not running the show. And Luke Groman says fiscal dominance, and Alden says fiscal dominance. And with the interest rates where they are, the amount that needs to be refinanced next year, this is a fiscal conundrum. This is the end game, and this is. But what relatively inexperienced persons that hear that word endgame need to understand endgame takes decades. And as Japan has shown, when you start to see 100 trillion on the Fed balance sheet and it's bumping up by 30 trillion a year, that's the awkwardness that I mentioned. It's going to get weird.
Yeah, it is. Yeah, Japanese 10-year had a huge move this morning too. So that thing's going basically parabolic. But the BOJ has basically said that 1% is their cutoff. But all these bondholders that bought down in here are gonna be getting wrecked, and that I kind of ascribe to the sort of Max Payne mentality of markets. Like I feel like the Max Payne theory of markets is the best way to truly think about things. And like, to me, I feel like the boomers have enjoyed the most luxurious, like
40 years.
40 years. And I think that they're about to get some real pain, because, and it's not just them that's going to be hurt in this. It's going to be everyone. But I think on the other side of that pain, I think people in the younger generations will finally see some actual like good things come out of this, when all is said and done. But it's gonna, like you said, it may take a decade or two for this to all shake out. But like, if you're a pension, like how many of these these boomers are holding like just pension fund? They have their pensions tied up in this crap. Um, who knows what else their pension funds are holding, like mortgage-backed security, commercial mortgage-backed securities, private equity. I mean, those two things are going to get obliterated in this interest rate market. Like, it
So,
there's no longer free money. You can't just roll over assets that don't produce cash uh indefinitely anymore. And you can't just pretend not to take the balance sheet right off, because eventually one of these things is going to blow up and it's going to become insolvent, and then it's going to start selling this crap. And when it starts selling this crap, then all this other
then,
crap is going to have to be marked to market.
and then this thing goes literally vertical, and you start seeing go up 1% a day, and all of a sudden you're at 10%. Everyone's freaking out. That is a worst case scenario. That is looks like it's somewhat the first innings of it.
Yeah.
There's gonna
And I that is what I expect to happen. That is what I expect to happen. I expect interest rates to absolutely destroy large chunks of the economy, and to punish all those that benefited for all these years due to the low interest rate environment. Because like, we've had so many years where it's just, when you have falling uh interest rates and a market that is becoming increasingly collateralized, like how much, I mean, basically after 2008, like the Fed, I don't know how much you followed the whole LIBOR scandal stuff, but did you see that like the guy that went to jail for LIBOR came out and wrote a book and basically said that he was railroaded into doing that by the Fed?
wow.
Um, and well, not just the Fed, but I think it was Bank of England too. But like, and this guy had to take the fall. And it's basically like, and then right after that, the Fed started doing the LIBOR. They used that scandal as a, you know, reason scandal, as a reason to clamp down on these unsecured lending markets, because they wanted everything to be collateralized. And because they got mad that in 2008, LIBOR was going one way and collateralized lending and the rate that they were setting in the market wasn't listening.
So they didn't have control.
They didn't have control, and it made them look silly. And so they were like, we're going to kill LIBOR. And the problem is that they did that, and they made this transition right down here at the bottom, at the peak of asset values. They have converted the world into collateralized lending. And so now you have all the world's dollars are wrapped up in collateral. And that collateral becomes less and less valuable the higher these interest rates go. And when that goes up, it unwinds. When that goes up, it unwinds. And you're just going to see
A cascade.
yeah, and that's what happens. That is what happens in there's a great paper also by a guy I follow on Twitter, called Liquidity Cascades. I can't remember. Oh, Corey Hoffstein. That's the guy. But it's a really good paper. I recommend people go take a look at that. But but that's the thing. That is what happens. And we see this in crypto where you get, like when you would get those up, this guy's getting liquidated up, it drops the candle down, boom, 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 and it all clears. But the thing is, in crypto, it does it quickly because it's all block by block. In the real world, this stuff takes a long time because you got to go through bankruptcy courts and you got to go through all sorts of legal shenanigans.
It's there's only one answer to all this. It's all going to get bought. It's what they did in March. They papered over SVB. They're going to paper over everything they have to in order to finance social civility. And whether the Fed, I question like the main narratives. Like, is the Fed targeting consumer price inflation? What the heck? I think that's awkward to even think that that's what they're interested in. No, look at these numbers, look at these charts. They're everyone's mandate is that you don't get the liquidation cascade from depreciating collateral pricing. Because otherwise, it doesn't matter what consumer price inflation is, because then banks are facilitating net 30, net 90, and there's no shipping, there's no manufacturing, and who cares what? Then that's how you really set inflation ablaze, because then you manufacture a credit sourced supply disruption. You don't have supplies, you don't have service, you don't have services, because all of corporate America runs on bank credit to finance operating expenses between to account for the differential in accounts receivable and settlement. So yeah, I don't know. I don't know how these businesses are running on net 30, net 90, running at these five, whatever the hell these bank interest rates are on the
Well,
credit products they're offering.
I did see an interesting chart the other day that was basically like, and to some extent this is sort of expected, but like basically businesses on average are actually paying less interest than they were a year or two ago. And the reason for that is they're not taking out new loans. They're not getting new financing. They are paying down their existing financing with cash flow so that when it does come time for them to come due, because a lot of companies were smart and they pushed their duration out significantly when the getting was good and we were down here. Like they borrowed a ton of money and they pushed the duration out to like 10 years. And so now they have like, 5-10 years to pay that stuff down
No interest
before they
rates.
have to roll it over.
Yeah, but
And
it's not. That's the duration. That's the growth based debt. It's that short credit. It's the operating expense credit, day to day credit, where you have a revolving credit account, a cash account at the bank that you
yeah,
could draw on to fund operations. I That's got to be expensive. That's got to be at market rate.
yeah, yeah. I mean, but then you also have companies, certain companies, the ones that are actually going to survive this, that actually have cash flow, are now making 5% on their cash. And so um, there's actually a reason to hold cash beyond just acquisitions and whatever. Like they can actually, you know, benefit from everybody else's pain with said
This
cash.
results. This is the decimation of small business America. This is the same terminology I use in crypto markets. What survives? Well, the only thing that survives in traditional finance is a business that actually has cash flow, that has the optionality of using bank credit to finance operating expenses. Like Amazon. Amazon has enough cash flow and enough leverage and weight from a business negotiation standpoint, that that they don't need that interim financing on a month-to-month basis. This is getting weird. I mean,
Yeah.
moves going down. I mean, so what?
Well, and I would expect it to, honestly. I would expect the move to go down just because there's been so much issuance that there is liquidity. And like, but like as you pointed out, you have gotten a lot of foreign buyers of treasuries.
Yes.
And that's because they're the money that makes the world go round. And people need that. And so that's what's also pushing the dollar higher right now, in my opinion, is that in order to buy a treasury, you need $1 and you spend that dollar to buy said treasury. Now there's fewer dollars lurking
Yeah,
around the system. And
you could do
so,
swaps though too. So that's big out of China is cross currency swaps. So you're not buying the dollars, you're acquiring the dollars.
yeah, I mean, you can do that, but that becomes more and more expensive as that trade gets more crowded.
Of
Like,
course.
and at a certain point, it stops being worth it. But I mean, and then you see also there's been talk of the basis trade getting big again, which is, basically for those that aren't familiar with how like the typical basis trade works. The stereotypical one is the yen, right? Like Japan's had super low interest rates for a super long time. And it has, so if you can, what you do is you borrow a bunch of yen and then you use swaps to hedge that against dollars so that you don't have to worry about currency risk. So then you borrow a bunch of money, you hedge it against dollars, and then you swap it to dollars and buy US assets that provide yield in excess of the interest that you're being charged. And when you do that, you then get to capture that spread. And so you can, I mean, and not everyone hedges this stuff 100%. Some are willing to take on some currency risk in this stuff. And right now, interest rates are, going up in Japan. And so there's kind of, I don't know, like it's been building and building and building this basis trade because US has jacked their interest rates so much higher than Japan, and the cross currency swaps have been actually reasonably priced. But eventually that stuff unwinds, right? And then and when it does, and that's basically what happened in 2020 is you had a giant basis trade blow up. And like there's no reason that that's not going to happen again. In fact, we're almost to the same like nominal place we were in 2020 right before that all happened. So like,
Wait, the trade blows up and they do the trade to buy US long end. Don't they have to sell their long end at a loss in order to get the dollars to buy the yen to unwind their leverage yen position?
yes.
So there goes the yield on the long end, 10%.
Yes. Yes. And so it, when that happens, you typically see the yen, spike like crazy, I think, because everybody's got to buy their yen because they've been just selling. So let's see, actually, where's my yen chart? Boop, boop. There we go.
Look at the yen in 08. Jesus.
Yeah. Like every now and then these basis trades just blow up on you. And then everybody's got to sell dollars to buy yen. So
Wow.
that can get unpleasant. So
Well,
basically,
that
yeah,
just
07 into 08, it
oof.
was just nothing but pain here. as
but then
the dollar depreciated against the yen.
whew,
And there's I saw an article in Bloomberg the other day about how like the Chinese yuan is kind of becoming a popular choice for that same trade. Now, the thing I would be concerned about is like your money getting trapped over there just because of all the controls that they have over their currency.
you can't mess with
And
that stuff.
I wouldn't touch that with a 10-foot pole, but there are people that, and maybe that's just comes from my ignorance of how that system works. I mean, maybe if you know the system well enough, you can get around whatever controls they have. I am by no means an expert in anything I'm talking about. So,
No, that means you touch it even less.
yep.
You know, it's not something like
But
that.
and to bring to kind of put this in crypto terms, that's like bridge risk, right? Is if you can't bridge your money back, you are incurring risk, and that's what happens in in TradFi. That's capital controls. I
Pretty much.
can't get my money back. They close the bridge. But
If we could shift to optimism, and I see like just the most incredible setup for next year for risk assets, and it's obviously quite the contrary to the prevailing trend of rates and all the things that can blow up. But I mean, just look at Move. I think Move has the capacity to just get smushed. And then there you go on the dollar. There goes the DXY. I mean, that's pretty much my base case over the next 15 years is DXY to like 60. For a global collusion standpoint, they just need to devalue the dollar. Otherwise, none of this works anymore.
yep. Yeah, we'll get basically, a redux of what happened in the 80s, where that you get this mass collusion between all of the powers that be, because the dollar just gets too powerful, and you get the what was it, the Accords, I'm totally blanking, but you know what I'm talking about. Is it the Geneva? No. Screw it. But yeah, there was basically a big thing where everybody got together and said, hey, the dollar's too strong. We got to
The
devalue this
Plaza
thing.
Accords.
Plaza Accords. That's the ones.
There's not enough dollars.
Yeah.
So energy is really in the forefront. Obviously, we get big energy spike, but that's what the whole raising of the rates is supposed to do is secure demand. So there goes energy. Energy should fall off at some point. And if energy falls off, there goes the dollar. And if move keeps going down, there goes the dollar. Because if you have low volatility in the collateral markets, you're not buying dollars, you're printing dollars. Oh yeah,
Yep.
yeah.
Yeah. I mean,
Some-
it's a mess.
yeah.
It truly is a mess. I don't know. I honestly don't see a way out of this. And they have all these ways of like kicking the can down the road, and it's like maybe that's just where you need to put your head, is like, if I was a bureaucrat trying to kick this can down the road, how would I do it?
The value of
Because
the dollar.
yeah, and that's really the only option at this point, and to do so by way of the Fed balance sheet, because that is the politically most expedient way to do it. But the problem is, like, I just don't see at a certain point, like I guess this is a question. Like, what assets are you not willing to put on the Fed balance sheet?
Well, at this point, how do you devalue the dollar? Fed buys foreign currency.
I mean, I could see, like, if I just don't, I cannot conceive of a way in which this Fed could possibly instill discipline on this market, because this is like the kid that's like, 6'8" and just trouble, and his mom's this tiny little lady, and she's trying to be like, I'm gonna take you over my knee, and like it's just
like, it's not happening.
yeah, good luck with that. Like it's
I-
it's just not gonna happen because it's getting so big and out of control that like and the thing I don't understand is like, let's just say that commercial real estate does blow up, right? You say you get a blow up in commercial real estate or private equity. The Fed has pretty much like in the past been like, no, we're not going to put that trash on our balance sheet. But they also said that about mortgage-backed securities once upon a time. But the problem comes when the loss of those assets in this collateralized lending world puts a hole in somebody else's balance sheet.
The cascade.
And then that firm then has to scramble to repair said balance sheet, and then it all unwinds, and they do that by selling their deepest, most liquid assets, which are treasuries. and like I still think you could see massive spikes in the move as you get these sort of liquidity cascades. And the other thing about the move is that like we're about to go through another debt ceiling battle. And I think you could once again see a giant spike in the move as all the new issuance gets eaten up. And then you get into this debt ceiling battle again. And we kind of go through what we went through earlier this year, where everybody's worried about, the Fed being, or the Treasury being able to actually issue things. And then you get another big spike and move.
Notice where the move spike is, by the way, March of 23.
Yeah, exactly. Because everybody was scrambling for safe liquid collateral and or cash, just straight up cash for reserves.
Cash. That's why. And the March 23 is when the banks blew up in the United States.
Yep.
And March 2020, those two spikes. That's as simple as that.
That was the dash for cash and COVID.
You see another spike and move, something else blows up, more shit goes on the Fed balance sheet. It's gonna get weird.
Right. And just like we said, so there's another thing. There was a tweet I did a while back that you tend to have dollar spikes during periods of like so the last time the dollar spiked, it was when collateral was getting super short, right? Or actually, no, I said that wrong. So like basically the dollar spiked, right? And then for these months here, this was when collateral was becoming scarce, right? And so that was because people were making dollars with said collateral, right? And so when collateral is scarce, dollar goes down. When collateral becomes plentiful, dollars go up. And I think that's what we're experiencing here, is that like collateral is becoming plentiful quickly. And that is sucking dollars out of the system, making the remaining dollars far more valuable. Eventually, we are going to get to the point where too many dollars have been sucked out, and then you're going to get a giant blow off top on the dollar again.
Oof.
And then, rinse, repeat. You get oh, there's so much money, so much reverse repo, so much everything. And then
listen, you see a
boom.
higher on the dollar on the DXY, and it prints 130.
Yeah.
Everyone, I don't know what everyone's gonna do. You get rid of everything and you get out of the cities. That's just a remarkable concept if because the whole system was ready to blow with the dollar at 114, 115.
Yeah. Looks
They're,
like
they're gonna the collusion that I see is suppressing bond volatility. Yellen says it always, the liquidity of the largest market on the planet. They suppress bond volatility. They get moved down to 70, 60, and there goes the offshore printer. DXY falls off a cliff. And I mean, there has to be at least the next cycle, and that there is literally time boxed on this. The system can't handle 11.5 to 13 trillion dollars of issuance fresh on the run, which means someone has to buy it. For that those treasuries to be sold at auction, cash needs to come into the treasury. And so that means yields go up, and then at those rates, it's none of this works next year. It's over next year. So somewhat the fun thing that we're waiting for is to see the collusion required for the game to
yeah.
not be over.
Yep. And you know, the game may be able to be extended too by
But
way,
not be,
and honestly, I think that may be the path that we take, right? Where Congress gets all fiscally hawkish and they start reeling it in.
what
And
are they going to reel in? Are they going to reel in Medicare? They're going to be
yeah.
slaughtered. Are they going to cut Medicare in half at these rates? At these rates, the interest on the debt is going to be approaching Medicare next year.
Yeah. Yeah. I mean, they're gonna have to do something. And well, and here's the other thing is the US government, and this is something that frequently gets pointed out by Luke Groman, that the US has become so reliant on capital gains for their tax receipts that they almost need to pump the markets in order to be able to fund the government. And
Yeah.
and so, like, I don't know, man. I don't know.
It's coming, and the cycle will turn. The liquidity, Mike Howell talks about all the time, that the bottom in ISM, everything's turning up. The bottom in the liquidity cycle is turning up. Yesterday was a great video on Real Vision. Mike Howell was on the daily briefing, and the cycle is already starting to turn. And but my base case is basically, does something break between now and liquidity starting to trajectorily turn upward? Because if that happens, then cycles will cycle, and that's the kick of the can, that they were able to finagle interest rates, they were able to finagle fiscal and tax receipts, so on and so forth, enough to squeak through to get to at least another liquidity cycle. Now, the refinancing cycle is probably, in my mind, going to impact the peak of the liquidity cycle, and obviously the trough as well, because if you have a massive peak in a liquidity cycle, you get a massive trough. You have to drain all of that out of the system. And this is the resonant phenomena that's occurring. The peaks are higher, the troughs are lower. And it just, everything screams of resonance right now.
Yep. Yep. And that's exactly what you would expect in a world that is based solely on collateralized lending. You know, like, uncollateralized lending was what used to catch the knife.
Yeah.
You know, because you could go, you know, I may not have any collateral right now, but I'm about to go buy some.
Oh my God.
I'm going in.
I'm not
Like,
fond of the solutions. Like, it's this whole thing is gross. Like, this whole construct and the things we talk about from a macro perspective, it's really gross. Like, nasty, disgusting. It's a gross shit. Um, and the easiest, the simplest thing to do is to say you can't issue currency, but that doesn't fix credit. So how do you fix credit? And that's the biggest thing I think about, because Bitcoin doesn't fix credit. doesn't do anything with regard to credit.
No,
It's not
they don't
even,
like credit.
but that doesn't work. You don't. There's no such thing as a system. Humans don't operate in a world where credit doesn't exist.
No.
When you operated on gold, it was credit. It's a silly reference to point out gold. It's just the concept of credit is independent of whatever prevailing medium of exchange there is. So that's the biggest problem. The federal government has control over the dollar. It's been extremely. They've been removing it from circulation this year. M0 is down significantly. Um, so, so it's not just the currency. The problem that I see is really credit. You could always point at the federal government for being pretty shitty at managing their balance sheet and just borrowing too much and using credit too much and printing, so on and so forth. But it's the credit that's the problem. That's a bigger problem than
Well,
the currency.
and this is the problem with getting away from unsecured lending entirely, is that you have deprived the world of something that it used to run off of. And what can happen is, like, institutionally, people forget how to manage those risks because they just don't do it anymore. And it may take time before we get those skills back after this whole thing blows up and and we go back to a world of sanity.
Secured
Well,
credit, where
yeah,
you post collateral and you put skin in the game when you're wanting to take on the risk and you don't pay. Unsecured credit is literally the lender taking on 100% of the risk. 100%.
yeah,
And oh, my credit score. Oh, I'm so scared. I default on $1 billion and my credit score gets hit.
yeah. Well, it's like they say, if you owe the bank $100,000, that's your problem. If you owe the bank $100 million, that's their problem.
It's their problem. So that's what I see is the biggest thing, and that's why I like the products and the enterprise that I do, because these are the things that actually fix credit, where the institution that's extending the credit literally is sociopathic with regard to protecting itself. I mean, obviously that is a personification of imparting emotion onto the institution.
Yeah,
That's not the case. It's just this determinism. Determinism
yeah,
in software is what fixes credit. It's the humans that cause the problem, the subjectivity. All right, let's strike a deal. We'll take on some of the risk and we're going to lend this to you. No, get the humans out of the equation. Software, that changes everything. That's what fixes everything. They say, you know what they say? They say Bitcoin fixes this. And I say immutability and determinism is what fixes the financial system from a credit perspective.
yeah. The more I learn about this stuff, the more I just, maybe finance was a mistake.
It's a big global mistake.
Like, because, like, we find these ways to just hide all these different risks in different places, and then eventually we find them, and then
They blow up.
that process of finding them gets very violent. Whereas, maybe we shouldn't be efficiently moving risk around. Maybe we should just leave the risk where it is.
The risk needs to be with the person taking the risk, not with the person offering the risk.
Yeah.
That's the creditor versus the debtor.
I mean, I guess to some extent, I understand the concept of finance is basically to move the risks into the hands of people that best understand those risks and can evaluate them. And there's a certain amount of specialization that occurs within different forms of risk. And I think that's, on net, probably a good thing. The problem comes when you have governments trying to step in and protect people from risks.
Moral hazard.
that is the definition of moral hazard. And that is where we are, is that there's so many risks that have been protected that are working counter to one another, that nobody knows how to operate the system, because it just,
It's subjective.
but they still want more and more control. They think that the reason it's out of control is because they don't have enough control of it. And that's not how markets work. That's not how humans work. That's not how money works. Money is like water. It flows where it is freest to do so. It follows the path of least resistance. And those risks go where the moral hazard is the highest, inevitably. And
in this system right now.
yeah, and then you get a blow up. And then, in order to protect all the people that you said you were protecting all along the way, you've got to embrace all that moral hazard and make some more.
I'm fond of an infrastructure that takes no risk. And when credit is extended, it's only the creditors that have the risk. Now, obviously, that presents the case in a cascading liquidation scenario where the default of one creditor can affect other creditors.
Yeah.
But it's only ever the creditors and not the institution creating the credit.
Yeah.
Or the debtors, not the creditors.
I do think, though, that like uncollateralized lending is worth having. I don't know that you can, or you can or should completely get rid of uncollateralized lending, because I think that trust is what
is collateral.
Well, it is a form of collateral. You're right. It is a form of collateral. It is a human form of collateral. And it's very difficult to there's no chain link oracle for the amount of trust I have in Captain Rational. But like
right.
But like I do think that having the ability to extend someone credit because they're good for it, I think that helps make the world go round and it removes frictions that perhaps don't need to be there.
Yeah.
And I don't know that you can do that in a deterministic way. I mean, I guess you would have to have some sort of algorithm to divine trustworthiness, or
it's a credit
maybe you just
score.
Chat GPT. How much money you think I'm worth?
In the end, like the Bitcoin folks get, the maximalists will say monetary policy and currency needs to be deterministic. I'm fond of that from an extremist standpoint with regard to credit systems. I think humans are the problem in these systems and subjectivity, and I would like to see what happens if you could only acquire credit if you take 100% of the risk, which means probably over collateralization, and I think that fixes a lot. Now maybe that's not necessarily the case, but I don't think there's any comparison in history, and I don't think there's ever been a system that actually allowed that to occur.
I agree that solves a lot of problems. But again, I don't think what you run into there is liquidity risk. If everyone is trying to de-risk at once, then you get these liquidity cascades. And if you are not the fastest at unloading your collateral, then
But who took the risk?
But you did. And that's ultimately what you want, is you want the people who took the risk to get punished.
So what you're describing is what happens if too many folks took out debt from tapioca and Bitcoin goes down 75% and everyone gets blown out. But at the end of the day, what's still standing?
Yep.
The damn protocol is standing. And
Yep. Yes. I I definitely think that there is something to be said for all that, for sure. I mean, I once you get humans involved, it does make it not. I mean, especially with collateralized lending, that should
Yeah,
be deterministic. There's nothing else to do. It's okay. You have
rules,
defaulted. Yeah, there's rules. They're followed to the T. It doesn't matter if you
permanence,
are the son of a former president or just me in my basement. Like,
same thing.
doesn't
The
doesn't
rules.
matter. It's all the same.
That's what Bitcoin fixes with regard to monetary policy. The rules are deterministic, at least relative to the stability of the network or the security of the network, and that's meaningful. The That's what I can't get over that with regard to immutability. The only thing I ever knock Bitcoin on is it's inflationary, and everyone argues it's fixed supply. Every damn day there's more of it in circulation. It's just inflationary, and every single human being alive today will be dead by the time we get to see if
Right. Well, and the funny thing is it's been inflating this whole time. But you ask about, you know, hey, maybe we should have some sort of tail emissions on this thing so that we can keep the network secure. And no, 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 you can't do that. It has to be 21 million. It has to be no more, no less. And it's like you've been living with these emissions for years now, and everything was going great. What's wrong with just having like a 1 to 2% tail emissions to keep the network secure?
what matters. And what Bitcoin did was immutability based on consensus. And what should be occurring is these types of proposals and
Yeah.
these types of merge requests and these types of attempted forks. We haven't had attempted forks in a long time, and that's a normal consensus process,
Yep.
and that's a critical part of iteration. And anything that doesn't iterate is not innovating.
Yep.
And so I find that unfortunate.
Yeah.
That's what Udi, I like the way he talks.
I love Udi. I love Udi. He's awesome. He's a good dude. I like that he takes the maxis to task and understands their stuff better than they do.
I mean, literally, the worst thing in the world is the lack of change.
Yep.
The only way to continue to make progress is for change to occur. I mean, that's inherent in the word progress.
Yeah.
Lack of change is antithesis of progress.
And like I understand that Bitcoin, they wanted to keep it as simple as possible. They
That's
wanted
cool.
to make it to be as fixed as possible, as decentralized as possible. And all those sorts of things are laudable,
That's great.
especially as a base money. I understand. That's what they
Yes,
that's what they want to create. But you also I think the thing that they've gotten the most wrong though is just the refusing to allow for speculation, and that it's like a religious thing for these people that Bitcoin needs to be this pure thing, because if it's not pure and it just gets relegated to another shitcoin casino, then it's somehow impure and it's not what Satoshi wanted. And like I take issue with that whole view that like Satoshi saw this as programmable money and he wanted you to program on it, not
there's no
not just like let it sit just the way he made it, in 2008. Um
The
and
L2s
then
are interesting. I like the L2s. I've always liked the L2s on Bitcoin ever
yeah,
since Syscoin started poking around with merge mining.
yeah, the problem with the L2s is that, at least maybe I'm not as familiar with them, but like I think you need a way to roll up onto the layer one. And like I feel like maybe I'm wrong on this, but my understanding is that like the opcodes and stuff that are available on Bitcoins really severely limit the options for a layer two to be able to do that sort of thing.
Well, maybe not a layer two with regard to roll ups and you know, because as long as you're attaching to the security, so you're not using Bitcoin for storage, the immutability of its network. Because if you are using Bitcoin security, another network is inherently inheriting that security. So you don't have to store that information on Bitcoin. Bitcoin's not very suitable for storing information. It's expensive and so on and so forth from an ordinal perspective. So that's what Syscoin does with the merge mining. It was literally like an EVM fork, but using Bitcoin to merge mine. So that's where the hash power came from. I always
Got
found that interesting. And they're obviously roll ups and storing it somehow on Bitcoin is potentially interesting. But what is the most interesting thing probably about Bitcoin? I mean, it's not its monetary policy necessarily, it's its immutability, its resistance to mutation, its hash power. So anything that inherits from that, I think, is quite meaningful.
Yeah.
Anyway, we digress.
Yeah, we do. That's what we do, though. It's been about an hour. I mean, we could probably call it here.
I got a lot of work to do this afternoon. I
Yeah.
appreciate it. Let's do this more often
Yes,
because
we
obviously
should.
things are going to get spicy. We'll keep an eye on the long end, and if we get a blowout, I'm sure folks will want to hear about it.
Absolutely.
Maybe move literally just falls off a cliff. You see move at 60, you know what's going to happen to the DXY and FX markets, and there goes liquidity, and it's going to go vertical, and there
Yeah.
goes risk markets.
Yeah, I mean it's one of those things where those two things they tend to move opposite one another. The collateral and the dollar spot liquidity, they tend to, when everybody wants these dollars, they lever up the collateral and then it gets like this and then this and they just kind of move opposite one another.
That's right.
And
I'll
this
leave
dance.
on this. It's the perfect storm next year, in my opinion. So they've been issuing at these high rates, which is cheaper price point for collateral. So obviously euro dollar is still spinning and they have all this collateralization. So if everyone did what they did in 22 and 23 on cheap collateral, and then you get a rally in the bond market and becomes more expensive collateral, and they need to issue 11.5 to 13 trillion dollars next year to be bought. What do you do with that collateral? And all of a sudden, you have a boost in price and collateral. So there's the potential in my mind for an absolutely massive tsunami of liquidity flooding the
I
system.
agree. I agree that very well could happen. And for me, the time that I would be aping would be the next move spike.
If there's another move spike, it is going to not just break shit. It's with these yields, it's going to destroy balance sheets.
Move spiking is bullish AF because they're going to just unload a wave of tsunami of collateral and whatever it takes to fix it. So
Otherwise, it's game over.
Yep. And
Thanks
there's
for
one
playing.
thing. There's one thing we know: the game will persist.
They will finance social civility.
Yep.
Thank you, my friend.
All right. Very good. Good chat. This is Exit Liquidity signing out. Try not to be Exit Liquidity.
Stay rational by not being Exit Liquidity.